Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Tall Looks podcast. Today is actually really interesting. We've got a couple episodes actually recorded that haven't been released yet, but as of the actual recording of this, so I don't know if the episode will come out. This is the 100th episode that we've recorded for the podcast. So appreciate all those that tune in, and going to do something a little bit different. We're going to try to add in a segment here of the podcast, doing just a market recap, talking about the market a little bit and the markets maybe, and what we're seeing and maybe some things that we're paying attention to or watching. Going to keep it a little bit broad, but just kind of give some information, because I think a lot of the media gets really skewed on stuff. We get some goofy questions if all you do is watch, the media. Anyway, so bear with me on this first one. I tried to lay it out. I want to look through today. Hey, like how's the stock market doing? A little bit air quotes there, but essentially we're going to look at like the S&P 500. How's that kind of doing? And then what are some knock-on effects or things that are potentially happening in the market? We're going to look at the bond market, talk mortgage interest rates, the dollar and currencies a little bit, and how it all plays together, some expectations maybe at the end around inflation. And then if I haven't rambled on too long, I have maybe some bonus content around all the rest. So let's kick it off. The first chart. This is going to be a chart heavy podcast too. So if you can watch this on YouTube, you may enjoy it better. I am going to be referencing the charts a lot. So we're going to kick it off. First chart I have for you guys is just a easy chart, S&P 500. On the bottom here, we've got the S&P 500, and we can see back here we've got the big drop last April. It did close up on the year last year, but what you see is this series of higher highs that's kind of petering out in momentum towards in Q4 last year and kind of continuing on. And up top, what we have is an RSI. It's an indicator, relative strength indicator, a very common indicator in the market. But what we see is a series of lower highs, right? And so from a technician perspective, we call that negative divergence or bearish divergence. Essentially, it's just saying that, hey, although the market's grinding higher, momentum isn't confirming it. And that oftentimes the divergences tend to resolve towards having some kind of breakdown and corrective period in the market. And so with this divergence going on all the way back to the end of October, I would even argue like beginning of October, potentially. It's the more they happen, the more likely they become an issue, right? So just something we're keeping an eye on. And then to support that same sort of idea, here's a different indicator that looks at momentum. But rather than looking at a daily chart, we're looking at a weekly chart on this one. So a little bit more zoomed out. And this has what's called a MACD or moving average convergence divergence. It isn't an oscillator per se, but what you can see here, and this is maybe the important part, when the black line drops below the red line, that's generally perceived as being your sell signal, if you will, right? That's the momentum breaking down. There's a histogram, that's the red and the green bars. So when the red bars show up on the bottom side, that's kind of when you would look and say, okay, that's now the momentum is sort of negative, you could say, in the market. And if you look, this indicator's been done a fairly good job at actually marking major market tops, right? So it would have kind of called it, at the end of 21, before the bear market of 2022. You would have caught a little whipsaw in October of 23, and then it actually called the market pretty early. You would have gotten out of the market about in January of 2025. Now, here's the struggle on it: is that this type of indicator, it really only marks or suggest tops if the market is at a top. So if it's already in a corrective phase, it's really not that reliable. And then it's really bad at telling you when to get back in. But what you can see is that histogram is tightening up. And so, kind of comparing those two things or putting them together, there starts to be some weakness. I think there's some potential weakness here in the S&P 500. If we look and say, okay, well, what does that, mean? What I want to do next is show valuations and talk about valuations a little bit. I'm not a huge valuation guy. I went to school in a fundamentals program, but I think it's actually not really too indicative of direction of market always. But when I think about valuations, I listened to a presentation one time by a guy named Jay Coppell, and he said, hey, recessions are the investing equivalent of jumping out the window. Valuations aren't a timing tool, but they will tell you what floor you're on, right? So it just kind of shows us like, hey, how bad could it get if you went through a real correction here, right? And what we can see is that the S&P 500 is this black line on top, and the blue, orange, and green lines below it actually are at that same time, what would the price be of the S&P 500 based upon an earnings, right? So 20% price to earnings multiple is considered overvalued still. But that's what that's the value of the S&P 500 if you did a 20 PE. 15 is fair value historically perceived, and then green is undervalued at 10, right? And I think there's some number of things that are broken in the markets that I just don't really think, short of an actual Great Depression, we're going back to a PE of 10. But even if we said, okay, well, like what would it look like to get to a corrective phase here, just for illustrative purposes, where you go through and get back to like, hey, at least that like kind of normal overvalued perspective. And you're talking about a 32, 33% potential, loss or pullback in the markets from where they're currently at. And about a 50% loss to just like fair value. So when I look at that, I kind of just say, look, the market's been really good. We're kind of priced for perfection, as Bob Elliott mentioned in our episode towards the end of last year. So if earnings continue to rise, then markets can continue to grind higher. But if there's any kind of hiccups this year, I expect to see some sort of turbulence, and I think that's what's starting to slow the momentum in the market is this caution and concern around that. So just that's my quick perspective on that. Let's look at things a little bit of a different way. The next chart I'm going to show you here is the equal weight consumer discretionaries ETF of the S&P 500 versus the equal weight consumer staples ETF. So the way to interpret this chart is, hey, when the chart is going up and to the right, it means that consumer discretionary, things like Tesla, are doing really well, right? They're leading the market. People are spending money. When it's going down, it means that all of your consumer staple companies are leading the market, right? Or outperforming on at least a relative basis. So maybe they're all going down, but they're going down less. So your consumer staple companies are like the Walmarts, the Costcos, these companies that people kind of have to shop at or participate in the market. What we can see is we had this really interesting, false breakout, then a false breakdown last year in April. Put us in a little bit of a channel, and we're kind of grinding higher. But we have, again, that negative momentum divergence, really not confirming that on an equal weight basis, that consumer discretionary is outperforming. So this is something really interesting to watch and watching right here. The last couple weeks, hey, is this going to break down further and then become a major topping pattern? And that could be a lot of trouble for the stock market ahead. So certainly something that you want to keep an eye on if you're at a stage of life that you want to maybe manage your risk or, manage how much volatility you're exposing yourself to, which is going to lead me into my fifth chart here, which is like, hey, Brandon, if the market is looking a little bit overdone here, or the market's looking price of perfection and could be a little fragile, what should I do here? Or, hey, isn't that Brandon? Isn't that why, I've always had in my 401k or my financial advisor, whatever, they have me in, 60% stocks now and 40% bonds. And for a lot of years, that's gone well. But let's take a look at what has happened with the correlation of stocks and bonds. And so we've got the black line is the S&P 500. I'm sorry, this chart is a little bit messy, but this thinner line here that it's kind of oscillating up and down is actually the rolling correlation of the U.S. bond index, or the U.S. Ag bond index, relative to S&P 500. And what we can see is there's this, all of a sudden, this huge divergence. And this really is 2021. This is COVID, and then 2022. And the world, I think, really fundamentally changed. And then all of a sudden, we're seeing like the correlation rise with the market. And so the correlations between stocks and bonds have somewhat broken depending on the time frame you're looking at. And you have to ask yourself, are they adding the diversification I'm expecting them to my portfolio here? Now, if you're owning them for a income component, right? You want to have a specific or particular endogenous return profile to a portion of your portfolio. That is one use case for it. You may look for other instruments than something like just the ag index for something like that. I think there's better risk adjusted ways to do it, but you really want to be evaluating, why do I own bonds in this market, right? Because as we saw in 2022, they can, and that was a particularly gruesome year for bonds, but they can go down and not give you that same diversification or lift when the equity markets, aren't as stable as they have. And so why do I say this? Why do I really think that wasn't a moment in time and everything's kind of fine now? Although it's not as bad as it was, I will, concede that point. So here, this is a really long-term chart up next here on the 10-year Treasury yields, right? So this is just, hey, what is the interest that a 10-year Treasury note is paying? And this is largely what is perceived to be like the risk-free rate. Generally, when you're pricing financial assets, it's a big driver of a lot of things in the market. And what we can see is, hey, in the 60s and 70s, it really just climbed up. And that was the era of inflation that some of you more senior listeners may remember, right? And it peaked under the Paul Volcker in the Fed. And if you look at that rate up there, it's about 15.5%. Now, the reason it affects the markets that way is because at a certain point, if 10-year treasuries pay 15% and equities are perceived to generate 8% over time, it's just too compelling to not sell your stocks and to go buy some bonds, right? And so as more people sell stocks, it drives the price down because supply and demand dynamics. What we saw after that is, after the back of inflation was really broken by Paul Volcker, you have this trend line where for 40 years, the interest rates came down, and at the end, they had their really in this chart, it goes down, but it's almost like a blow off top, right? And that's when we saw mortgage rates at 2.5%. The 10-year Treasury was down here during COVID at 0.5%, right? On its face, that's a horrible deal. The math is easy to do. Do you want to get 0.5% for 10 years? That's like not a great return. I think most people know that. And it's unsustainable. So what happened is it corrects back eventually. And in 2022, as they raise rates, people know, hey, the gig's not up. This isn't going to be the Swiss markets where there's negative interest rates. And you break that trend line. What's interesting is you come back and test it. And that's usually a good indication if that holds. That's a really fundamental area of support now. And that interest rates are going to be structurally higher. We've seen them rise higher. And now they're in this interesting channel where they sort of began back in the 60s on their march higher. So if we zoom in a little bit on the next chart and just say, okay, let's zoom in on what that looks like. You see that same part that was in green at the end on the last chart is now trading in this wedge, which tends to be what they call a continuation pattern. And so from a technical perspective, if you had to sort of, put your money one way or the other at this point, I would anticipate this breaking out to the upside. Now, normally we like charts that go from the lower left to the upper right. Those are generally our favorite charts. In interest rates, not so much. Remember, the interest rate is inversely correlated to the price of bonds. So if your interest rates are going up, that means that the price of your bonds are going down. And that's what happened in 22. And I think that is still a potential out there. A quick note before I show you I'm going to show you two other bond pieces, and then I'm going to show you some additional supporting evidence of maybe why I'm viewing things this way. Here's mortgage rates, and it's not the mortgage rate proper. What I'm showing you is actually a ratio of the spread between the 10-year Treasury and mortgage rates. A lot of people will talk about mortgage rates. There's a lot of information out there, a lot of mortgage lenders, a lot of real estate agents that think they understand mortgage rates, and they will talk about what the Fed is doing. Well, at the end of the day, mortgage rates aren't priced upon the Fed or the Fed interest rate policy. Now, Fed interest rate policy at extremes can drive the rest of the bond market for sure, or at least be an input in the dynamic when you're looking at trading bonds or taking arbitrage or relative value trades. However, mortgage is more closely aligned in duration or effective duration typically with the 10-year Treasury. And so they're priced largely off that. If that's the case, you may be asking, Brandon, why are they higher than the 10-year Treasury? Because we know that there's no credit risk in mortgage bonds. The government backs them and essentially guarantees that they are going to be paid, right? So there's no credit risk. Why are mortgage rates higher than 10-year Treasury? There's a couple reasons. A minor one is the cost of originating that loan, warehousing it on books, and the hedging activity that actually has to happen by issuing banks when they're packaging and warehousing that risk as they package it into mortgage-backed security to sell it into the secondary markets. It's a relatively minor cost compared to what's actually the option that you're buying in a mortgage. And so when you're looking at mortgage pricing, there's a 10-year Treasury really plus this option. And so what option is this? This is the option that you have as somebody taking out a mortgage to prepay the loan. In a lot of bonds, most bonds, you can't prepay it, right? So if you take out a loan for 10 years, you pay it for 10 years and then you pay it off, right? In mortgages, you can move, you can refinance, you can do all these things that allows you to pay the money back. Well, as a bond investor, you don't want the money back when interest rates go down. That's when your bonds normally go up the most in price, right? And so because mortgage bonds have that feature or that optionality, mortgage borrowers have to pay the investors, they have to pay them a premium, right, in order to have that optionality. And so when you have that optionality shrinking, it's essentially the bond market saying, hey, we really don't think that the refinance wave is going to come through and we're going to get paid back. So we'll continue to price down our mortgages and we're going to continue to absorb them into the market, and we are not going to demand a high premium. Whereas if you saw, we just looked at where the 10-year Treasury got down to 0.5% in COVID, and mortgage rates did get pretty low, but they really had a hard time getting below. I think the index didn't get much lower than 3. I know there's some people that got really sweetheart deals below that, candidly myself included. But what you saw is this huge spike right here. Well, that's investors saying, hey, we need more option premium. And so it's looking at a period right here where I don't feel like the mortgages at this point are really pricing in this huge refinancing wave. If you were pricing it in, I think we would see that spread widening a little bit is my perception. The other thing to look at is credit spreads, right? So if we talk about credit, a different type of bond metric here, if you look at, in this one's using high yield or what people sometimes call junk bonds. This is your poor credit people. This is your low credit scores, essentially your low credit score companies. So this spread is saying, well, how much extra do you get for having, this lower credit quality, right? And so you can see if we kind of look at the timeframes when there was market stress, like, hey, last April, man, you get more all of a sudden. You get more in 2022. You get more in COVID. If we go back far enough, you can see like, well, okay, in 2008, you get way more. You get potentially, as much as 20% more a year in high yield bonds when there's these times of stress. Well, why? It's because you're basically expecting people to never pay it back. You're pricing in the defaults. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. Well, what we can look at and observe, right? And I'll leave it here for a second. We're really low. That spread is really tight from a historical perspective. You're almost as tight as you were in basically the late spring of 2007, right before things started coming unwound. But what's interesting is bonds tend to price it in a little faster than the stock market. And so you saw the spreads widening already in June of 2007 as things kind of came unwound. They didn't peak out until the end of 2008. Well, what's interesting is the market didn't bottom until I believe it was March of 2009. And by that point, the spreads on high yield bonds had already started contracting. So high yield bonds actually tend to lead the market. And so although things are really tight in the bond market, going back to how it relates to stocks, maybe the way to say it is like, yeah, it hasn't been spooked yet. The last couple of days, last week or week and a half, we've seen it rise a little bit coming off of a really tight low bottom. But I think until credit spreads really start to spike, you don't have to have too much angst about the market. So that kind of covers the interest rate complex a little bit. Let me give you some additional ideas on why there's some other things I'm looking at, why I think that way about stocks and both bonds. What might be driving this fragility here? So, let's see, I got to go back up here. Next chart I'm going to show you in this update here is what's the relative performance of TIPS or Treasury inflation protected bonds relative to what they call nominal bonds or just your regular bonds. So this is actually comparing just two ETFs. So this is the TIP or TIP ETF versus the IEF, which is a 7 to 10 year Treasury bond, very common ETF used. And what we can see is, so here's back in 2020, all of a sudden inflation takes off, and the way to read this chart is that when it's going up, Treasury inflation protected securities are outperforming nominal bonds. It's tightening the spread between the two, and or it's tightening the tip spread. And what that essentially is investors pricing in inflation expectations, right? If you're an investor and you think inflation is coming back, well, you don't want regular bonds, you want inflation protected bonds. Right. And so, reload that. What you end up with is this interesting pattern where, hey, inflation took off, broke out of this downtrend, ran all the way up in 22, and then it traded in this somewhat of a flagging pattern and then broke out. And then when it came back down, it found support on that same trend line, which is a little bit interesting from a technical perspective. And that's done it again. And now we're right at a point. We've put in this last little base here. We're in this kind of key zone. And if that continues to break out, which it may or may not, but to me, this looks like there's continued upward inflationary pressures. Okay. Do I have anything else to support this thesis or observation I'm seeing in the market from a technician perspective? Well, here's an inflation beneficiaries ETF, right? Well, how does this look? Well, they launched this in 21, and you can see post 22, after the big commodities run, you go through this big consolidative period. And then you break out in 24, which is interesting. And then this last year, you put in this big old base right here. It recently broke out last fall, and then it retested here going into the end of the year, and it's completely bounced off and shot upwards. So we'll see. I would just say, I'm not recommending anyone run out and buy a bunch of inflation protection or retilt a portfolio a certain way, but it's something certainly to keep an eye on, because as inflationary pressures creep back into markets, it disrupts the bond market. As the bond market gets disrupted, it bleeds over into the equity markets, right? They're all interlinked and the dynamics play together. What else is going on? Well, if we look at gold relative to the S&P 500, what we can observe is, again, how do you observe this chart? To give you a quick understanding, when the chart is going up, it means that gold is outperforming the S&P 500 on a relative basis. When it's going down, it means that the S&P 500 is outperforming gold on a relative basis. Now, this is significant because what we see is, remember when we had interest rates break out to the upside and we had those inflationary pressures in the 60s and 70s? Here's what it looks like. Gold drastically outperforming the S&P 500 until interest rates started coming down and inflation subsided. Gold at that point had a really interesting thing that central banks had to do, which was they realized they had all this gold and they thought they were never going to need it again. So gold until the mid 2000s became net sold by central banks. Central banks sold their gold, and that really suppressed the price of gold. Meanwhile, the S&P 500, because inflation was coming down, right? It's really good for the economy and stability, and the economy grew, and S&P 500 really outperformed gold. Now, what's interesting is if you bought gold in 2000, as fringe as people might think you are, in some ways, you've done fairly well with that trade. You did really well until the last peak in gold, and then you had this consolidative period. But what's interesting is this last consolidative period that I would say, obviously it started in 2011 and the base really started building in 2015, a couple of years later, and then has this big multi-year base that goes all the way until the end of last year. And that base is significantly higher on the relative performance chart than the prior low of the S&P to gold ratio, or gold to S&P ratio rather. So this is indicative to me of a structural change in trend. And now you have this big base and it's breaking out to the upside. So what does that mean? And by the way, it's confirmed by momentum indicators. So what does that mean? It means I think gold potentially has a real possibility of outperforming the stock market on a relative basis for probably a good period of time, several years. Now, that doesn't mean that there's not going to be very painful days, weeks, or months in gold that maybe the stock market does really well. But if you're looking at gold and saying, in my opinion, I don't want in my portfolio because it doesn't pay dividends, or, stock should do better over time, I think you're missing a really interesting way to add diversification to a portfolio and actually capture a really interesting equity-like return if we anticipate that it might even outperform the stock market. Again, on a relative basis, that simply can mean that they both go down, but gold goes down less, right? So some people buy gold as that portfolio insurance component, and it might shine on the chart through that type of theory, right? So there's a number of different reasons to own it. It's an interesting dynamic here, especially with gold, is the US dollar. Now, a lot of people call for the the dollar to blow up or the dollar to collapse. There's some of these terminologies here. And what you have to remember is the dollar is just a relative basis, right? So dollar is a currency, but the rest of the world is on fiat currency as well. So when we talk about in foreign exchange markets or foreign currency markets, and we talk about the dollar, we're oftentimes referring to what's called the Dixie or the DXY index. And what that is it's a basket of currencies from our trade partners relative to their strength relative to the US dollar. So they all can go down in purchasing power terms, but the dollar might strengthen on a relative basis, be a better performing currency, right? Or the international currencies could be better performing. In the dollar index, it's largely constructed by the euro is the largest component. You also have the Great British Pound and things like the Japanese yen, among some other currencies, in relatively small weightings. Now, again, remember that if the US goes to print money, that means you could have a collapse of the dollar from a purchasing power perspective, right? And that's oftentimes maybe like Bitcoiners, theory of the world. And they're not necessarily wrong in that. But if the European central bank or the Japanese central bank looks at the situation and says, well, if US is going to print to stimulate, we're going to do the same thing. You could actually have a strong dollar on a relative basis. That matters for trade. And what Trump is wanting is he's wanting the dollar to be weaker. He's wanting the dollar to go down in my perspective. I believe that's a signaling that he's putting out. And the reason why is because what it does when the dollar is strong, it's really cheap to import stuff. And that's why we've been this big importer of goods. And that's what he's trying to correct with the tariffs. So in weakening the dollar, it makes it more expensive for us to import stuff, which again, I think is going to potentially bleed into that inflation conversation. But the dynamic is that it becomes cheaper for other people to import stuff from us, right? So whether we just produce more goods in-house, so to speak, onshore and sell it domestically in our own economy, or other countries engage in us with trade in a different manner, that's the intent of the dollar. Now, if we zoom out on the dollar, we can see where it's at in a historical perspective. A pretty normal spot right now. I wouldn't really call it much oversold. It's around it's 97 currently, 90, almost 98. 100 you might call parity or just normal. And you can see, in the late 80s, mid 80s, it spiked to a really extreme level. But you also saw a pretty high level coming off of the .com bust. And if you have spent enough time on financial media, what you remember is in the early 2000s when you had the .com crash, a lot of people's portfolios were carried through at that point, not by US stocks for once, right? It was actually their international allocations. And I've talked about this a lot on the podcast before. And a lot of times those international allocations, it's not always so much about getting the country or the company right, rather, or how's that country's economy exactly? Like, is it a great stock? It's actually, a lot of it is in the currency trade. And so if the dollar just goes down and you have an asset that's priced in a different currency and you hold that asset and then you go to convert it back to dollars in a weaker dollar, you'll get more dollars for it. So that's the currency component that you can have in your portfolio to potentially protect against different environments like this. Well, what we can see is that bottomed out in 2008. And, if you have been watching since 2008 or 9, international markets, largely both developed and emerging markets, have significantly underperformed the US markets. And that is because every time there's been a concern, there's somewhat of a flight to the dollar safety, right? As the reserve currency of the world. What we're seeing, I think, here is a potential next leg down on having some kind of meaningful breakdown for a period of time. I don't think the dollar's going away. I think the US currency is going to still be alive and well, and the typical means of trade and exchange that we almost all use on a day-to-day basis. The purchasing power of it, right? Maybe a Snickers bar ends up costing $30 by the time I go to retire. I don't know, right? I'm not making a call there. I'm just saying, I think the dollar is going to be around relative to other fiat currencies. But that the policy being put out by our government currently is one that is seeking a weaker dollar, in my opinion. And so a meaningful break below this 69-ish level, I think, is going to continue to further do that. Now, I think below that, you have about, this 89, 88 level. That will be interesting. If you break down below that, it probably gets pretty wild for a minute, but it's relatively short-lived after that. What you'll want to do looking out further is potentially, if you are the person that has that diversification in your portfolio and you do end up with international positions or other currency trades, there will become a point when you want to look to get out of those and be back in US-based assets so that you can take advantage of being in dollar-priced assets, right? So how does this play back through? Let's look at what I was just referencing with similar to the stocks versus gold conversation, or gold versus stocks rather. Let's look at S&P 500 or US stocks as a proxy for US stocks relative to the stocks from the rest of the entire world, right? So this is really just domestic, essentially a proxy for domestic stocks versus international. And I've been a big bull of US equities, right? We can see that going back to 2009, there's this pretty defined channel, an upward trend of US stock market outperformance. What's interesting is last year you have this breakdown, a complete break of the channel for the first time in, over 15 years. Well, the part that's hard to read on this whole thing here is that the dollar is still a really good currency relative to the other fiat currencies. Sometimes it's often called the cleanest shirt in the dirty laundry. And what you can see here is you have some support all of a sudden in this ratio chart, like significant support. In fact, I'll highlight it for you really quick with a trend line. It's right actually where we're at. And what you can see is there's been this interest. It peaked out here, kind of touching that line both in 2022. And then it had some, a tough time breaking above it in 23, ripped above it last year. The S&P ripped above it in second half of 23, 24. And then in the beginning of 25, it came back down and retested that same level in April last year. Then you had some US outperformance and then a meaningful breakdown towards the end of last year now again. And we're kind of back there. So we'll see what happens here. It's something to worth monitor. But just like when we had on the S&P that bearish divergence on momentum, you're having somewhat of a positive divergence on momentum on this one. And what that means is as you're coming in here and you're putting in a potentially new low on this chart, momentum really is not fully confirming that move. There's this really tiny, slight positive divergence in momentum from the last time it was down there to this time it's down there. And so I'm not really solar convinced either way that this is going to move. It's just really something interesting to keep an eye on, that if it breaks down, I think it could be a more secular, sustained move that you may want to consider repositioning portfolios for. I think that was really the last chart I had for you. Caleb, how are we doing on time here? What are we at?
36 minutes.
36 minutes. I have probably bored everyone to death with my takes today. So I will leave it at that. I think those are the big themes to really be looking at in the market is, hey, how are US stocks doing, especially on the large industry levels that most people are invested in? That momentum is slowing. There's a lot of positioning that's, in my opinion, observably a little bit crowded. And a meaningful breakdown could cause some rather quick volatility and drawdown that most people don't appreciate. It also could end up being a really good buying opportunity long term if the underlying fundamentals of the economy are re-accelerating potentially, and it just becomes a short-term correction to be able to look through. I think looking also at inflationary pressures in the economy, what that could do to the bond market, and having the right expectations around interest rates could really help people navigate their personal financial choices as well. And lastly, monitoring and managing your currency risk, whether you choose to do that through international allocations or gold positions or direct currency positions. There's a number of ways to do it. But it's something that you would want to potentially monitor, keep an eye on, and stay abreast of. We're certainly in a changing world, in my opinion, right now. There seems to be and I'll talk about this maybe in next month's update, something called resource nationalism, if you want to look that up a little bit. But it's to say the least, a very interesting world right now. And I think it's largely changing. So the things that have worked in the past may not work so good going forward. And, our job here is to try to give educational content to help guide people into a comfortable retirement on time and stay that way, right? Be able to stay retired. And there's a lot of unique risks out there that need to be managed. So with all that, hey, we always welcome comments, questions, concerns, jokes, hate mail, whatever you got for me. Please go ahead, send it. Happy to review it. You can always reach us on ducharmewealth.com. Yeah, you're more than welcome to look at the number of advisors we have on our team there and reach out to any of them directly if there's one that catches your eye, or you can just simply use our contact us page. We have a begin discovery process button if you want to go that way and potentially just start a discovery process with us to see if there's something that we could do to help you in your life. With that, we appreciate you guys supporting us this is our 100th recording. Like I said, it's been a big project. It certainly takes a lot of effort on my end to do this, but I've gotten so much feedback from people that they find it interesting, that they find it meaningful, and that's the stuff that keeps me going. So I appreciate you guys all, and we will see you guys out there.